Going on, ladies and gentlemen? Welcome back. It's great to see you. Jason, Britt, Lady Kim. Awesome. Here's what's going on. Oh, real quick, let me fix this chat box. There we go. That's better. All right, folks, buckle up. We got a bombshell. America's largest bank, J.P. Morgan Chase. And this isn't just your run-of-the-mill financial news. This could very well shake the very foundations of our economic stability. A whistleblower, someone who was inside the belly of the beast at J.P. Morgan, has come forward with allegations that are absolutely scandalous. According to a report by the International Consortium of Investigative Journalists, the whistleblower claims that from 2016 through today, basically the better part of the last decade, J.P. Morgan Chase has been pulling a fast one on all of us, including the Office of the Comptroller of the Currency, the Federal Reserve, and all of the government's largest organizations. They've allegedly been misrepresenting how risky their operations are in order to dodge having to keep larger cash reserves, which are supposed to act as our financial safety net in times of crisis. You can see here, article just came out a couple days ago. A bank whistleblower accuses J.P. Morgan Chase of violating cash reserve regulations, pocketing $2 billion per year in the process. Now, this whistleblower detailed in a 35-page letter to J.P. Morgan's audit committee and accuses the bank of using shady accounting tricks known as netting. And this isn't just bending the rules, it's outright breaking them. Netting and bilateral netting is legal, but not in the way that JP Morgan used it. Under both Federal Reserve regulations and international standards, by doing this, JP Morgan made itself appear less complex, less risky, and allowed him to hold less capital in reserve than required, and saved them billions of dollars in margin collateral in the process. Essentially, the implications are staggering. And by understating their risk, JP Morgan reportedly could have issued between $75 billion to $100 billion more in loans than they should have been able to. And that's not it. The manipulation allegedly helped them pocket an extra $2 billion per year that could have been a cushion for our economy or stayed in the pockets of the American taxpayer instead of lining the pockets of one of the richest banks in the world. Now, the whistleblower didn't just sit on this information. They raised concerns internally way back in 2018. And instead of being hailed as a hero for protecting our financial system, right? They faced retaliation. They were squashed and eventually laid off in 2022. And this isn't just about one person. It's indicative of a culture where speaking out against wrongdoing might get you the boot, or even worse, blacklisted from working in the industry in its entirety. And we look here at the quarterly report on bank trading and derivatives. We can see that there is massive risk in these top four banks, particularly in JP Morgan. Looking at the top four banks, in case you guys didn't know, there are a total of 1,225 insured U.S. and national, state, and commercial banks and Savings Association that hold derivatives. Of those, four, just four of those 1,200 plus banks and institutions hold over 88% of the total banking industry notional amounts of derivatives. The net current credit exposure to this is $237 billion. And when we look at these top four banks, you can see them here in orange, is the top four banks, over $194 billion worth in derivatives for them alone. And all of the other 1,222 banks combined account for just a measly $30 billion there. Or should I say, I'm sorry, I said billions. I said billions. This is much, much larger than that. Let's take a look at why. 194,000 times a billion. That's trillion, of course. Excuse me for misspeaking there. We've gone over these reports many times in the past, but just a bit of a slip up there. They don't have 194 billion. They have 194 trillion dollars in total notional derivatives liabilities. Of course, because you have to take the 100,000 they have here and multiply it by $1 billion. So these top four banks make up $194 trillion of the total notional derivatives, and the other 1,222 banks make up the remainder there, about 36 trillion or so. You can see how much of it is obfuscated and hidden in total swaps, futures, forwards contracts, total options contracts. Credit and derivatives is a small portion of it, but swaps is the real big killer here, because swaps are what destroyed Archegos, and as a byproduct, their bank and prime broker, Credit Suisse, which was eaten up, of course, by none other than UBS. At the same time, when we look at value at risk for JP Morgan, it's quite substantial. You can see that the value at risk, which in case you're unaware, they use it to quantify the maximum expected loss over a specified time and a certain confidence level under relevant market conditions. Now, this value at risk here was already massive for JP Morgan risk. JP Morgan's value at risk, total risk-based capital, for the third quarter of 2024, this is the most recent data available that just was released by the Office of the Comptroller of the Currency. And that was $299.4 billion. The reality is that if they were lying about these numbers, as the whistleblower states, their value at risk was much, much higher than $299 billion. So the reality is that if something were to have happened and JP Morgan, say, would have collapsed, or there would have been a financial crisis of any sort, or even if still it happens today, JP Morgan's going to lose a lot more than $299 billion. You can see the numbers are big for the other banks too. Citibank's right behind them at $167 billion. Bank of America with $206 billion. And Goldman Sachs with $64 billion in value at risk. Now, a lot of senators have voiced deep concern over what seems like the Federal Reserve potentially turning a blind eye to this sort of misconduct. But this is a big news because now they're lying to everybody, including the Office of the Comptroller of the Currency. And these senators are worried that we are basically setting the stage for another economic meltdown because those who are supposed to police Wall Street are way too cozy with them. As you can see here in the notional amounts of derivative contracts, JP Morgan Chase has only $3.5 trillion in assets, but maintains $60 trillion in total derivatives. And that's pretty substantial until you realize that there's a lot more, because their holding companies have $4.2 trillion in total assets for JP Morgan alone, with another $59.4 trillion in total derivatives. So combined, we take JP Morgan's bank in the United States and their offshore holding companies, and they equal about $7.7 trillion in total assets, posted up against $129 trillion, $129.5 trillion in total derivatives. So as we stated before, these guys can use something known as bilateral netting. And it is fairly beneficial in reducing their gross credit exposure, which is eliminated through bilateral netting in percentage. See how high this bar is here for 2024? It's high for a reason. And even still, the amount that is used is incredibly low, because the netting benefit is not always going to be able to work. And basically here, a legally enforceable netting agreement between a bank and a counterparty creates a single legal obligation for all these transactions. This is called a net setting under the agreements. Therefore, when banks have such agreements with their counterparties, contracts with negative values, which is an amount that a bank would pay to their counterparty, can offset contracts with positive values, an amount owed by the counterparty to the bank. You can see here that some transactions may be subject to the laws of a jurisdiction that does not provide legal certainty of netting agreements, in which case banks must regard such transactions as separate from the net setting. And what this means is that JP Morgan has been illegally pocketing $2 billion a year for the last decade. And potentially could have caused a financial meltdown that would make Bear Stearns look like child's play. Now, JP Morgan, have they responded? Has Jamie Dimon responded? There has been crickets out of them. No direct denial of these allegations. Just a statement saying they comply with all capital regulations. And from the Federal Reserve, nothing. So this raises the question, of course, are they complicit? Are they ineffective? Are they incompetent? Or are they just criminals working together within this sector, putting American investments at risk? This isn't just a few people, but I mean everybody in the United States, whether you're invested in stocks, bonds, whether you have a 401k, a pension, an IRA, a thrift savings plan, or just a stock account, is at serious risk, because this isn't just about a bank making a few extra $1 billion. Think about that. Think about how much is $1 million. That would be really beneficial to you right now, right? Now think about 1,000 millions. Having $1 million 1,000 times over. That's $1 billion. This is about the integrity of our entire financial system. And we already know that JP Morgan is ridiculously over-leveraged with $7.5 trillion in derivatives. $7.5 trillion in assets versus basically $160 trillion in derivatives notional asset value here. Potential losses. So if these allegations are true, where our banks, the very institutions that are supposed to safeguard the economic health of Americans and people around the world, the fact is that they're playing games with our future. And they're not any bank. They're a global player. Any instability here would have a massive domino effect around the rest of the world. If banks are gaming the system on their reserves in order to maintain their collateral requirements and have to put up less capital in order to maintain their margin requirements so that they don't get margin called, the next financial crisis would hit the world without buffers. And if you remember 2008, which most of you over the age of 20 likely do, we're talking about a potential repeat where taxpayers would again be on the hook if banks like JP Morgan don't have adequate reserves. And this is a wake-up call on the integrity of our financial system. If these are substantiated, it could mean that the rules designed to protect us from 2008 on steroids are being flouted right under our noses. And the silence here from JP Morgan, coupled with the lack of immediate action from regulators, amplifies the urgency for transparency and accountability here. People need to demand answers, not just for the sake of one bank, but the stability of the entire global economy. And this isn't something new either. Take a look at this. As I was pulling up, doing my due diligence and my research, as always, on these situations, I found this from December 18th of 2014, in which JP Morgan Chase, of course, in case you were unaware, this is from Better Markets, a hugely respected company in and around the New York Stock Exchange that has been pushing for consumer protections for decades now. They found that JP Morgan Chase and Bernie Madoff's $64.8 billion Ponzi scheme and crime on Wall Street were very highly interconnected. They said, as the headlines have made clear for years, JP Morgan Chase has a long rap sheet of illegal conduct and often overlooked. It includes enabling Bernie Madoff's $64.8 billion Ponzi scheme, the largest in history, which caused the net losses of more than $17 billion in untold human wreckage. Some of you may be well aware that JP Morgan was also implicated recently for helping facilitate the child trafficking that occurred on Epstein Island, and directly knew about the situation that was going on with Jeffrey Epstein, but turned a blind eye to it. They even said that although not responsible for the crash and collapse, Madoff in handcuffs was in some ways the face of Wall Street greed and criminality. However, that is a false and misleading picture of crime on Wall Street. How could one guy pull off this crime? Like most substantially legal and criminal financial activities, Madoff had a very close relationship with a big Wall Street bank, JP Morgan Chase. Given the focus on the crash and the economic calamity of 2008 and JP Morgan's years-long efforts to prevent any information from being publicly disclosed, their role in enabling this massive crime wasn't known publicly for years. And that veil of secrecy ended when a complaint was filed by a court-appointed trustee to recover funds from the thousands of people that lost money. In the complaint, the trustee alleges that JP Morgan Chase was at the very center of the fraud and thoroughly complicit in it. Of course, JP Morgan Chase, the complaint stated, turned a blind eye to Madoff's fraud, very similar to what they did with Epstein Island and the facilitation of child trafficking there. And now we're seeing that once again, in which they are choosing $2 billion in profits over having to pay more to maintain their collateral positions, preventing margin calls, and even worse, putting your financial safety at risk. What they said even further that really got me was that they said what's most indefensible, despite a deep, close, and extremely lucrative relationship that lasted for decades, JP Morgan Chase wasn't even required to publicly disclose the information that detailed its complicity in Madoff's scheme, including how much money it made and how, who got the bonuses from the money of the thousands of people that were ripped off, and where those employees and officers are now, and how they could have ignored so many clear warnings over so many years that cost so many others a great deal, if not all, of their savings. And we are seeing that exact same thing happen once again through this scandal that has been pretty much being reported by the whistleblower for the better part of a decade, who was fired by JP Morgan Chase for doing so. Meanwhile, they maintain $160 trillion in derivatives. This is far from over. It's just the beginning. And this is only going to get worse before it gets better. People need to keep the pressure on these crooks for transparency and accountability. Now, this is based on a report from the ICIJ, and we need to critically assess what this means for our financial security. People need to keep an eye on this kind of thing, and it would behoove you to like and share this with others who might be affected, who might have money invested in the stock market or a pension or a 401k, that should probably know about what's going on so that they can prepare themselves in case something does. But we can do something about this. Here's where we can take steps towards financial empowerment. In light of these ridiculous revelations, it's more crucial than ever to seek out platforms that promote transparency and give back power to the individual. That is where LitExchange comes in. This innovative platform is not just another stock brokerage. It's not just another crypto brokerage. It is a game changer for financial security. By leveraging the Jobs Act Regulation CF exemption, LitExchange is offering something unprecedented: the chance for retail investors to own part of a stock brokerage firm before it even launches or goes public. This is the first time in the history of the world that such an opportunity has been afforded to everyday investors such as yourself. And by investing in LitExchange through the FINRA-regulated funding portal Silicon Prairie, you're not just diversifying your portfolio, you're literally buying into the future of finance, where the community has a say in how things are done. It's a step towards ending financial market manipulation that occurs every single day, that affects everybody in the stock market, ensuring that the power isn't just with the big banks, but with all of us. Remember, this is based on a report from the ICIJ. This is something that we know about, happens every single day. And we just recently found out that more than 51% of all trades on the stock market now are occurring in dark pools, where your trades are often front run by market makers and hedge funds, and your trades are internalized. And often you receive synthetic shares in your account, fake shares that artificially dilute the company that you're buying and that you're trying to make money off of, so that these big institutions can make money and you can lose money. Don't forget to check out LitExchange. There's a link over in the description right now and down in the live chat for a chance to secure your financial future and own a piece of the new wave in finance, in both stocks and crypto. Make sure you're properly hedged. Do your own due diligence. And so far, over 300 retail investors have invested over $500,000 in LitExchange. Do yourself a favor and check it out. Cheers, ladies and gentlemen. I wish you peace and wealth. Have a great rest of your day.